viewers at home, you are welcome to my lectures on complex group structure. In this lecture, I will be considering the fellow subsidiaries. Fellow subsidiaries. I will examine the meaning of fellow subsidiaries and the procedures for consolidating the fellow subsidiaries. I will equally consider the questions from past examination questions. Fellow subsidiaries. Two or more companies can be said to be the fellow subsidiaries if they are controlled by the same parents. If two companies are controlled by the same parent, they can be said to be the fellow subsidiaries of the parent. Take for instance, if you have HPSC, if HPSC acquired 80% of S1, and at the same time HPSC acquired 70% of S2, both S1 and S2 are subsidiary of HPSC, but S1 is not a subsidiary. S1 is not a subsidiary of S2, and neither is S2 a subsidiary of S1. Since both S1 and S2 are controlled by HPSC, therefore S1 and S2 can be said to be the fellow subsidiary of HPSC. Where two or more companies are subsidiaries of the parent and in which they are not a subsidiary to one another, they can be said to be the fellow subsidiary of the parent. So the procedures for consolidating fellow subsidiaries. Procedures, consolidation procedure. Number one, you draw the group structure. Draw the group structure. That is the first step. So try to watch my lecture on consolidated financial statements from part 1 to part 8, including an associate, before proceeding to complex group structure. Step 2. Present the summary of net assets. Present the summary of the net assets of each subsidiary. The consolidation of fellow subsidiary is similar to that of the simple group structure, which I have considered in part 1 to part 8, including the consolidation of associates. So try to watch all the lectures for better understanding. 3. Calculate the goodwill on acquisition of individual subsidiary separately. Calculate the goodwill on the acquisition of individual subsidiary separately. Calculate the goodwill on the acquisition of individual subsidiaries separately. Step 4. Aggregate positive goodwill. Aggregate the positive goodwill. Positive goodwill can be aggregated, but negative goodwill should not be offset against the positive goodwill. Maybe one subsidiary reported positive goodwill and the other one has a negative goodwill. You should not deduct the negative goodwill from the positive goodwill. Offsetting is not allowed. The negative goodwill, called gain on bargain purchase, should be added to the retained earnings of the parent, where the parent company policy is proportionate share of net assets. Positive goodwill should be consolidated, but negative goodwill, that is gain on bargain purchase, should be aggregated with the retained earnings of the parent, where the parent company policy is proportionate share of net assets. And where the policy is fair value, that negative goodwill, that is gain on bargain purchase, to be shared between the parent and the non-controlling interest based on the percentage of the group holding. So that is step 4. You aggregate the positive goodwill. Offsetting is not allowed. Step 5. Calculate the consolidated retained earnings. Calculate the consolidated retained earnings. How do you calculate that? You have the retained earnings of the parent. Retained earnings of the parent. Retained earnings of the parent. Then you now have parent share of S1 adjusted post acquisition retained earnings. Parent shares of S1 adjusted post acquisition retained earnings. We also have parent shares. Remember, S1 and S2 are fellow subsidiary of the parent. Parent share of the adjusted post acquisition retained earnings of S2. Meaning that the parent percentage, percentage of parent holding in S2 multiplied by S2 adjusted post acquisition retained earnings. So then you get the consolidated retained earnings. Where the parent company policy is proportionate share of net asset and the goodwill calculated is impaired, then you are going to deduct the impairment loss from the retained earnings of the parent. You don't need to share it. You deduct it from the retained earnings of the parent. So if you watch my lecture on the simple group structure, that is one parent, one subsidiary, from part 1 to part 8, including the consolidation of associates, you'll be able to understand that better. So that is step 5. Step 6. Step 6, calculate the non-controlling interest. Calculate the non-controlling interest that will appear in the consolidated statement of financial position. So you have NCI at acquisition. NCI at acquisition, that of S1. On acquisition of S1, then you also have on acquisition of S2. NCI at acquisition, you know where the policy is proportionate. So you have the percentage attributable to NCI multiplied by the fair value of net assets of S1. The percentage attributable to NCI multiplied by the fair value of net assets of S1, that will give you the NCI at acquisition of S1. Same is S2. So you apply the same procedures. So the NCI you have used when you are calculating goodwill, that is the NCI that will appear here. So I have told you that you must follow the parent company policy or the group policy. So we now have NCI share of adjusted post acquisition retained earnings of that of S1, then that of S2. So when you add it, you have the NCI that will appear in the consolidated statement of financial position. That is the procedure. These are the procedures for consolidating fellow subsidiaries. So we want to take a question as work example. This question is obtained from ICANN November 2014 corporate reporting. ICANN November 2014. The question is on the board. Then we will equally. So if you are also in need of the question, you can visit the ICANN website on www.icann-ngr.org. You check the Pathfinder. So that is where you can get the question. Example 1. Bagat PSC has two subsidiaries, Megat and Migat, and one associate, Kagat. Since adoption of IFRS by government, Bagat has been preparing its consolidated financial statements in accordance with the principles of International Financial Reporting Standards, IFRS. The draft statement of financial position of Bagat and its two subsidiaries as at 31st May 2013 are as follows. We have Bagat, we have Megat, we equally have Migat. Everything is in million. We have assets, non-current assets. Under non-current assets, we have plant 5,300, 4,600, and 3,220. We have investment, Megat 6,000, Migat 2,560. We have associate, Kagat 400. We have available for sale investment 1,020, 120, and 100. The total of the non-current asset is 15,280, 4,720, and 3,320. We have current assets. Under current assets, we have inventories 2,700, 1,100, and 1,460. We have trade receivables 1,820, 900, and 640. Then we equally have cash and cash equivalents 2,040, 2,000, and 160. The total of current assets is 6,560. We have 4,000 and 2,260. We have total assets 21,840, 8,720, and 5,580. We have equity and liabilities. We have share capital 10,400, 4,400, and 2,000. We have retained earnings of 4,800, 3,000, and 1,600. We equally have other components of equity 240, 80, and 140. We have total equity 15,440, 7,480, and 3,720. So that is the total equity. Non-current liabilities. We have long-term loans 2,400, 300, and 100. Deferred tax 500, 180, and 60. Total non-current liabilities, we have 2,900, 480, and 160. We have current liabilities. We have trade payables 2,300, 600, and 1,200. We have current tax payables 1,200, 160, and 480. Total equity and liabilities, we have 21,840, we have 8,720, and 5,580. The following information is relevant to the preparation of the group financial statements. On 1st of June 2012, Bagat acquired 80% of the equity interest of Megat PLC on the date of acquisition. The retained earnings of Megat was 2.72 billion, and other components of equity were 80 million. There had been no new issue of capital by Megat since the date of acquisition. The purchase consideration comprised cash of 6 billion, whereas the fair value of the identifiable net assets of Megat on this date was 8 billion naira. The excess of the fair value of the net asset is due to an increase in the value of non-depreciable land. An independent valuer has stated that the fair value of the non-controlling interest in Megat was 1.72 billion on 1st of June 2012. It is the policy of Megat to measure non-controlling interest. It is the policy of Megat to measure non-controlling interest on the basis of their proportionate share in the identifiable net assets of the acquired subsidiary and not at fair value full goodwill. The policy is proportionate. The policy has been stated to be proportionate share of the identifiable net asset, not full goodwill. But if you look at the question, you are given the fair value of non-controlling interest. So, since the fair value of non-controlling interest is given, and the policy, you have been told the fair value of the non-controlling interest in Megat was 1.72 billion. This is the fair value of non-controlling interest. This is the fair value of the non-controlling interest. And the policy has been stated to be proportionate share in the identifiable net assets. That means the fair value of the non-controlling interest is not relevant. The fair value of the non-controlling interest is not relevant because the policy has been stated to be proportionate share in the identifiable net assets. The policy have to be adhered to. You have to follow the policy. Even though you are given the fair value of NCI and the policy is stated to be proportionate share of net assets, that means you should not use the fair value of NCI. But where the examiner is silent as to the parent company policy, as to the valuation of the non-controlling interest, that means you have to apply the proportionate share of net assets. Where the policy is silent, so that means the policy should be proportionate. But where the policy is stated to be proportionate share of net asset, that means you have to follow that. But where the policy is expressly stated to be the fair value, it is then that you can use the fair value. Fair value of NCI should only be used where it is expressly stated, that is in form of statement, where it is stated that the policy is fair value. It is then that you can use the fair value method. But where the examiner is silent about the policy, then you use the proportionate. And where the fair value can only be used where it is stated to be fair value. I've told you that in answering this kind of question, the first thing you should do is to draw the group structure. So you have group structure, group structure. That is the first thing. You draw the group structure. So we have the parent. On 1st of June, Megat acquired 80% of the equity interest of Megat PLC. Megat PLC acquired 80% of the equity interest of Megat PLC. You have Megat PLC. Megat acquired 80% of Megat PLC. If you also look at the notes too, on 1st June, also on 1st June 2012, Megat acquired 70% of the ordinary shares of Megat. Megat also acquired 70% of the ordinary shares of Megat. Bagat has a stake in Megat. At the same time, Bagat has a stake in Megat. Megat is not a subsidiary of Megat, and neither is Megat a subsidiary of Megat. Meaning that both Megat and Megat are not one another subsidiary, but they are both subsidiary of Bagat. Therefore, Megat and Megat can be said to be the fellow subsidiary of Bagat. I've told you that the procedure for consolidating the fellow subsidiary is similar to that of simple group structure. That is the first step. Now you have drawn the group structure. Then the second step is the summary of net assets. Summary of the net assets. Summary of the net assets. Let's present that of the first subsidiary, which is Megat. Summary of the net assets of Megat. So you have for post acquisition, you have date of acquisition, and you also have the reporting date, that is date of consolidation. Date of consolidation, date of acquisition, then you also have post acquisition. Post acquisition. Then remember our retained earnings, our profit. We have for, let me have retained and post acquisition, retained earnings. Or we have retained earnings, we equally have other component of equity. Retained earnings, we also have other component of equity. So, on 1st of June, Bagat acquired 80% of equity interest of Megat. On the date of acquisition, the retained earnings of Megat was 2.72 billion. That is retained earnings. You have retained earnings. Don't forget, I've told you that the net assets are the equity. That means you have to share the equity of Megat. So the net asset, I've told you that they are equity. Equity comprises the share capital, retained earnings, and other components of equity. So if you check the equity, we have share capital, retained earnings, and other components of equity. That of Megat, the net asset of Megat is what we want to present. That means you use the equity of Megat. And we have 4,400 as the share capital. Then we also have retained earnings of 3,000, that of Megat, 3,000. Then we also have other components of equity, and we have 80 for Megat. 80 for Megat. That is the equity. On 1st June 2012, Bagat acquired 80% of the equity interest of Megat PLC. On the date of acquisition, the retained earnings of Megat was 2.72 billion. That is the pre-acquisition retained earnings. Then, under retained earnings, you have retained earnings here. The one at the date of acquisition, which is 2.72 billion. 2.72 billion, you have written M at the top. The That is 2.72 billion. And other components of equity were 80 million. 80 million. Other components of equity. 80 million. 80 million. M is at the top. Meaning that the post-acquisition retained earnings. So now, the share capital at the date of acquisition will be 4,400, since there were no issue of shares after acquisition. That means post-acquisition will be nil. Post-acquisition will be nil. Then retained earnings. We have 3,000 minus 2,720. So 3,000 minus 2,720. 3,000 minus 2,720. Then you have 280. The 280 is the post-acquisition retained earnings. Then we have other components of equity. 80 minus 80 will be nil. No other components of equity relates to post-acquisition period. So now, other components of equity were 80 million naira. There had been no new issue of capital by Megat since the date of acquisition. The purchase consideration comprised cash of 6 billion naira, whereas the fair value of the identifiable net assets of Megat on this date was 8 billion. That means the fair value of the identifiable net assets on this date, that is, the date they are referring to is 1st of June 2012, which is the date of acquisition. That means the fair value of this net asset at the date of acquisition is what we are given to be 8 billion. The sum of this should be 8 billion. That is what that means. Now, back to the question. The excess of the fair value of the net asset is due to an increase in the value of non-depreciable land. Meaning that the amount by which this 8 billion exceeds what you have here, the total of this. The amount by which the 8 billion exceeds the total of this, you were told that is due to non-depreciable land. The excess and is due to you were told the excess of the fair value of the net asset is due to an increase in the value of non-depreciable land. An independent valuer has stated that the fair value of the non-controlling interest in Megat was 1.72 billion. I've told you that that one is not relevant. So now when you sum up this, what is the total of the net asset? We have 4,400 plus 2,720 plus 80. The fair value of the net asset at the date of acquisition is 7,200. And this one is given to be 7,480. You were told this value should be 8 billion. That is what you are told. The fair value of net asset. You were told the fair value of the identifiable net asset of Megat on this date was 8 billion. That is, the fair value of net asset at the date of acquisition is 8 billion. So this value should be 8 billion. And you were told that the increase, the amount by which the 8 billion exceeds this, is due to non-depreciable land. So we have fair value increase. The fair value increase attributable to non-depreciable land. So which should be 800. Since the fair value of net asset is given to be 8,000. That means the difference of 800 is what is attributable to land. That is the net asset at the date of acquisition of Megat. That is the summary of Megat net assets. Also, we equally present the summary of net assets on acquisition of Mingat. Summary of the net assets on acquisition of Mingat. We were told also on 1st of June 2012, Bagat acquired 70% of the ordinary shares of Mingat. Oh yeah, let's have the summary of net assets on acquisition of Mingat. Summary of net assets of Mingat. Mingat. So I've told you that the net asset comprises, you have post acquisition, we have date of acquisition, we have date of consolidation or reporting date, and this post acquisition is divided into retained earnings and other components of equity. Retained earnings and other components of equity. So the net asset comprises share capital, then retained earnings, and other components of equity. Now, the one at the date of acquisition. Also, on 1st of June 2012, Bagat acquired 70% of the ordinary shares of Mingat. The consideration for the acquisition of these shares was 2.56 billion. That is the consideration transferred. Under the purchase agreement of 1st of June 2012, Bagat is required to pay the former shareholders of Mingat 30% of the profits of Mingat on 31st May 2014. This is an additional consideration that will be paid. So 30% of profit, that is based on condition. This additional consideration will be paid if they are able to make profit. 30% of that profit will be paid. That is to show that the additional consideration is contingent depending on the conditions. Share capital. So the share capital of Mingat is 2,000. Share capital 2,000. So we have 2,000. Then we also have retained earnings. Retained earnings of 1,600. 1,600. We have other components of equity. 140. 140. Then you were told that the fair value of this arrangement was estimated at 120 million. That is the fair value of the contingent consideration. The fair value of the contingent consideration. That is, on 1st of June 2012, Bagat is required to pay the former shareholders of Mingat 30% of the profits of Mingat on 31st May 2014. The fair value of this arrangement was estimated at 120 million at 1st of June 2012, and this value has not changed. This amount has not been included in the financial statements. The fair value of the identifiable net assets on 1st of June 2012 of Mingat was 3.52 billion, and the retained earnings and other components of equity were 1.1 billion and 140 million respectively. This is the retained earnings at the date of acquisition, which is the pre-acquisition retained earnings, and the other component of equity at the date of acquisition is 140 million. So now, since there were no issue of shares since acquisition, that means the share capital at the date of acquisition will be 2 billion. Then post acquisition will be nil. Then retained earnings is given to be 1.1 billion. So you have 1.1 billion. If you subtract it from 1.6, then you'll be the post acquisition retained earnings will be 500. Other components of equity at the date of acquisition is equally given to be 140 million. So 140 million. Therefore, post acquisition will be nil. Now, the total of this, the total equity is given to be 3740. 740. Then if you sum up this, which is 3,100, 3,240, 3,240. And this is the net asset at the date of acquisition, and you were told that the fair value of the identifiable net assets on 1st of June 2012 of Mingat was 3.52. That means the fair value of this net asset, no, it is 3.240, and you were now told that it is 3.52, and the retained earnings and other components of equity were 1.1 and 140 million respectively. There have been no new issue of share capital by Mingat since the date of acquisition, and the excess of the fair value of the net asset is due to an increase in the value of property, plant and equipment. And excess, the fair value is 3.52, and it is ought to be 3.240. That means the 3.52 is greater than 3.24. You were told that the amount by which this 3.52 exceeds 3.240 is an increase in the value of PPE. That means you have fair value increase, the one attributable to PPE. So if the total is 3.52, that is the total as given. So the difference 3,520 minus 3,240, there is a difference of 280, and that 280 you were told that it is attributable to PPE. That is the summary of net assets of Mingat. That is the summary of the net assets of Mingat. The next thing, the note 3, is about the acquisition of Kagat. Finally, Bagat acquired 25% interest in Kagat. This 25% only gives Bagat a significant influence. So that is to show that Kagat PLC is an associate of Bagat. Since Kagat is an associate of Bagat, that means we are going to use equity method to account for investment of Bagat in Kagat. Under equity method, you have the cost of the investment plus share of post-acquisition profit. So that will give you the amount of investment that will be reported in the consolidated statements of financial position. Now, we want to determine the value of goodwill on acquisition of the first entity is Megat. The value of goodwill on acquisition of Megat. So goodwill on acquisition of Megat. Acquisition of Megat. So you have acquisition of Megat. Let us have this as working 3 or working 3. Goodwill, we have consideration transfer. Consideration transferred, that is purchase consideration transferred. You check the information about acquisition of Megat. So on 1st of June 2012, Bagat acquired 80% of the equity interest of Megat PLC. On this date, on the date of acquisition, the retained earnings of Megat was 2.72 billion. And other components of equity were 80 million naira. There had been no new issue of capital by Megat since the date of acquisition. The purchase consideration comprised cash. So we have cash consideration of 6 billion. Cash 6 billion, whereas the fair value of the identifiable net assets of Megat on this date was 8 billion. So purchase consideration, we have 6 billion. So we now have fair value, we have NCI, non-controlling interest, at the date of acquisition. non-controlling interest at the date of acquisition. Now, the policy is proportionate share in the identifiable net asset. That is the policy. Though you are given the fair value of non-controlling interest. I've told you that the fair value of the non-controlling interest is not relevant since the policy has expressly been stated to be the proportionate share in the identifiable net asset. So now remember what Bagat acquired in Megat is 80%. That means the percentage attributable to NCI will be 20%. So 20% of the fair value of the net asset, the fair value of the net asset of acquisition of Megat is 8 billion. So 8 billion. So you have 20% of 8 billion. Of 8 billion. So 20% of that. So 8 billion, 20% of that will give us 1,600. 1,600. If you add the 1,600 to 6,000, you'll be having 7,600. So with that less the fair value of net assets at the date of acquisition. Fair value of the net assets at the date of acquisition is 8 billion. 8 billion. Acquisition of Mega, the fair value of net asset is 8 billion. So you subtract the 8 billion from 7,600. Then you'll be having negative goodwill of 400. This 400 is the gain on bargain purchase. Gain on bargain purchase. The gain on bargain purchase should be aggregated with the parent company's retained earnings. You are going to add it with the retained earnings of the parent company. So since the policy is proportionate shares, you don't need to share it between the parent and NCI. The policy is proportionate. That is why you are going to add the gain on bargain purchase, that is the negative goodwill. You are going to add it to the retained earnings of the parent. The next, we want to determine goodwill on acquisition of Megat. Let's call that working for. Acquisition of Megat. Acquisition of Megat. So you want to determine the goodwill on acquisition of Megat. Also, on 1st of June 2012, Bagat acquired 70% of the ordinary shares of Megat. The consideration for the acquisition of these shares was 2.56 billion naira. So we have consideration transfer. Consideration transferred. $2.56 billion. Under the purchase agreement of 1st of June 2012, Bagat is required to pay the former shareholders of Megat 30% of the profits of Megat on 31st May 2014. So meaning that the consideration transfer, you have cash consideration. The cash consideration of 2.56 billion. 2.56 billion. 2.56 billion. Then the fair value of this arrangement, was estimated at 120 billion naira, or 120 million naira at 1st of June 2012, and this value has not changed. This amount has not been included in the financial statements. So now there is a contingent consideration that if they make a profit of 30%, they will equally pay additional consideration, and the fair value of the contingent consideration is 120 million. Now 120 million. Then you also add the NCI at the date of acquisition. NCI at the date of acquisition. What Vanguard acquired in Mingard is 70%. That means NCI will own 30%. I've told you that you don't need the fair value of NCI since the policy has expressly been stated to be proportionate share of identifiable net assets. So we have 30% of the net assets of Mingard at the date of acquisition, which is 3520. 30% of that 3520, that will give us 30%, 3520. You calculate 30% of that, and that will give us 1056. 1056. So if you add it plus 120 plus 2560, the total is 3736. So from this, you less fair value of net asset, less fair value of net assets at the date of acquisition. Fair value of the net asset at the date of acquisition, which has been given to be 3,520. 3,520. So when you less this, minus 3,520, so you have 216. Finally, you less the impairment of goodwill on acquisition of Mingard. Goodwill arising on the purchase of Mingard was tested for impairment on 31st May 2013, and this provided evidence of impairment to the tune of 36 million naira. No accounting entry has been passed to reflect the impairment. Required, you are to prepare a consolidated statement of financial position as at 31st May 2013 for the Vanguard Group. So now we have calculated the goodwill on acquisition of Mingard, and we've obtained 216 million naira. And in note 5, you were told that goodwill was tested for impairment, and the impairment to the tune of 36 million was provided. So we cannot have impairment loss. Impairment loss. You are going to deduct the impairment loss of 36 million from the goodwill. So you have a 0. 3 from 11, we have 8. And here you'll be left with 1. So that means the consolidated goodwill is 180 million naira. 180 million naira. So that is the goodwill. Then in note, you were told that it's due to an increase in the value of property, plant and equipment, the fair value of the non-controlling interest. I've told you that we don't need the fair value of non-controlling interest. So the difference in fair value on acquisition of Mingard was due to PPE, and the property, plant and equipment is depreciated over 7 years. So straight line basis over 7 years. So you cannot have extra depreciation. Extra depreciation on PPE. You know, the PPE, the increase is 280 million. As calculated, 280 million divided by 7. Since PPE will be depreciated over 7 years, now from the date of acquisition to the date of consolidation is just 1 year. So times 1 year. So 280 divided by 7, 280 million divided by 7 it will be 40 million. So if you deduct the 40 million from 500 million, the adjusted post-acquisition retained earnings on acquisition of Mingad is 460 million. So the next thing from note 3, finally, you were told that Bagat acquired 25%. Bagat acquired 25% interest in Kagat PLC on 1st June 2012 for 400 million naira, achieving significant influence over that company in its financial and operating policy decisions. Kagat PLC retained earnings for the year to 31st May 2013 was 200 million naira. So that is, let's have working 5. Now, since Kagat only gained a significant influence, Bagat acquired 25% interest in Kagat PLC. That shows that Bagat has a significant influence in Kagat. So I've told you that where a significant influence exists, if you watch my lecture on investment in associates and joint venture, so you'll be able to understand that better. Where a significant influence exists, that the significant influence and the investee has, the investor has a subsidiary, that you are going to apply the equity accounting method. I'm telling you that using the equity accounting method, investment will be recognized at cost. So we have investment in Kagat, investment in Kagat, that is investment in associate. The associate is Kagat. So investment in Kagat, which is the associate. So you recognize it at cost. The cost of the investment, how much is it? So you go through the question. Acquire 25% interest in Kagat PLC on 1st of June 2012 for 400 million. The cost of the investment is 400 million. You adjust for the investor share of post-acquisition profit of investee. Now, how much is the post-acquisition profit? Acquisition is as 1st of June 2012. So, and they are achieving a significant influence over that company in financial and operating policy decisions. Kagat PLC retained earnings for the year to 31st May. No, the beginning of the year is 1st of June 2012, which is the date of acquisition. 1st of June 2012 is the date of acquisition, and the profit for the year to 31st May 2013 is 200 million. That is to show that from 1st of May from 1st of June 2012 to 31st May 2013, that is 1 year. And all the period from June to that May relates to the post-acquisition period. So that means the post-acquisition profit on acquisition of Kagat is 200 million. So we now have Bagat share of post-acquisition profit of Kagat PLC. What Bagat acquired in Kagat is 25%. So you are going to have 25% of the post-acquisition profit. 25% of the post-acquisition profit is 200 million. 25% of 200 million. So you calculate that 25% of 200 million, and that will give us 50 million. So if you sum it up, if you add that 50 million to 400 million, you have 450 million. That is the investment in associates that will appear in Bagat Group Consolidated Statement of Financial Position. The next thing is the retained earnings. Retained earnings that will appear in the Consolidated statement of financial position. Working 6. Working 6, we have retained earnings. Retained earnings. Retained earnings. Then you start with the parent retained earnings as per statement of financial position. That is the retained earnings of Bagat as per statement of financial position, which is 4,800. You have Bagat retained earnings as per statement of financial position, which is 4,800. 4,800. Then followed by Bagat's share of adjusted post-acquisition retained earnings. Bagat share of adjusted post-acquisition retained earnings of the first subsidiary is Mingat. We have Mingat. Then, Megat. The adjusted post-acquisition retained earnings of Megat is 280 million. 280 million. Then, Bagat shares of that of Megat. Adjusted post-acquisition retained earnings of Megat is 80% of 280 million. Since Bagat acquired 80% of Megat. So, 80% of 280 million, that will give us 224. We have 224. Then the second subsidiary is Mingat. Mingat. Adjusted post-acquisition retained earnings of Mingat is 460. 460. So, Bagat shares of Mingat adjusted post-acquisition retained earnings will be 70% of 460 million. 70% of 460 million, and that will give us 322. 322. Then we also have the share of post-acquisition retained earnings of the associate, which is Kagat. What Bagat acquired in Kagat is 25% to gain a significant influence. 25% of 200 million. The post-acquisition retained earnings is of the associate is 200 million. 25% of 200 million will give us 50 million. Then, upon calculation of goodwill of Megat, we had gain on bargain purchases of 400 million. Remember, the policy is proportionate share of the net asset. So, since we have gain on bargain purchase, you have gain on bargain purchase, that is the negative goodwill. Gain on bargain purchases, I said the negative goodwill should be aggregated, should be added to the retained earnings of the parent. It should be added to the retained earnings of the parent company. Then remember, goodwill on acquisition of Mingat was impaired, and we had impairment loss. Impairment loss of 36 million. Since the policy is proportionate share of net assets, so you are going to deduct that goodwill from the retained earnings of the parent. You deduct it from the consolidated retained earnings. So you aggregate that. We have 4,800 plus 224 plus 322 plus 50 plus 400 minus 36. We have 5,760. 5,760. That is the consolidated retained earnings. The consolidated retained earnings is 5,760. So we can prepare the consolidated statement of financial position. Other adjustment will be incorporated on the face of the consolidated statement of financial position. So you prepare for Bagat Group consolidated statement of financial position. You have Bagat, PLC Group. We have consolidated statement of financial position as at 31st May 2013. So you start with the assets. You start with assets. So you start with non-current assets. Non-current assets. As part of our non-current assets, you have plant. Plant 5346 3,220. So we have property, plant, and equipment. That of Bagat is 5,300. 5,300 plus that of Megat 4,600. For Mingat we have 3,220. 220. Then on acquisition of Megat, there was an increase in value of land from the summary of our net asset. On acquisition of Megat, you will see increase of 800 plus on acquisition of Mingat, there was a fair value increase of 280, and which was on PPE, and this is to be depreciated over 7 years, so minus depreciation of 40. So that will give you the value of PPE that will appear in the consolidated statement of financial position. 5,300 plus 4,600 plus 3,220 plus 800 plus 280 minus 40. That will give us 14,160. 14,160. That is the value of PPE that will appear in the consolidated statement of financial position. Then on acquisition of Mingat, we had goodwill of 180. That is working for goodwill of 180 from our working for. Then we also have investment in Kagat. Investment in Kagat, which is the associate, that is working 5. Investment in associate of 450. Investment in associate, that is investment in Kagat of 450. Then we also have available for sale investment. Available for sale investment which should be measured at fair value. Available for sale investment, there is no note on that, no additional information on the available for sale. So just sum up the value as per the statement of financial position. It is believed that this carrying amount is equivalent of the fair value. So we have 1020 plus 120 plus 100. So when you sum it up, so we have 1020 plus 120 plus 100. So the fair value of the available for sale is 1,240. 1,240. So those are the non-current assets we have. So you can sum it up. When you add it up, plus 450 plus 180 plus 14,160. The total of our non-current assets is 16,030. 16,030. Then we also have current assets. Current assets. Current assets. So the first under current assets in the statement of financial position, you have inventory. Inventory, there is no intra-group transfer of inventory. So, and there are no additional information on inventory, so just sum it up. 2,700 plus 1,100 plus 1,460. So when you sum it up, you have 2,700 plus 1,100 plus 1,460, and that will give us 5,260. 5,260. Then we have trade receivables. Trade receivables. Trade receivables. Then we have 1,820 plus 900 plus 640. You also have cash and cash equivalents. Cash and cash equivalent. We have 2,040 plus 2,000 plus 160. Then we have notes on that. We have notes on that. Note 4. Included in trade receivables of Bagat at 31st May 2013 is a receivable from Megat of 30 million naira. Unknown to Bagat, Megat has paid this amount through a bank transfer. So since this amount is included in trade receivable, you have to deduct that from trade receivables. So you have minus 30 million. That is intergroup receivables. Then we have unknown to Bagat. Megat has paid this amount through a bank transfer. Since it has been paid, that means it is no longer included in intergroup payable. It is no longer included in trade payables. So it is not included in trade payables. It has been paid through a bank transfer by the close of work on 31st May 2013. but it had not yet been reflected in the bank statement, of Bagat. It has not been included or reflected in the bank statement of Bagat. Megat has already passed accounting entries to reflect these transactions. Since it has not been included in the bank statement and that amount has been settled, so you are going to add it to the cash and cash equivalent. So you have 1,820 plus 900 plus 640 minus 30. That will give us 3,330. Then we also have 2,040 plus 2,000 plus 160 plus 30, and that will give us 4,230. When you sum it up, you sum up the current assets, the total of the current asset plus 3,330 plus 5,260, and that will give us 12,820. That is the total of our current assets. You add the current asset and non-current asset plus 16,030. The total asset will be 28,850. That is the total assets. After total assets, the next thing will be equity and liabilities. So that will be the next section. So you want to deal with the equity section now. Then under equity section, you have share capital, that of the parent. Since there are no share consideration, just put the share capital of the parent. Share capital. The share capital of the parent is 10,400. 10,400. Then followed by the retained earnings. Retained earnings. That is in working sys. Retained earnings is working sys, which is 5,760. 5,760. Then we have other components of equity. Other components of equity. All other components of equity relate to the pre-acquisition period. So meaning that of Megat and Mingat relates to the pre-acquisition period. Therefore, there is no share of post-acquisition other components of equity. Therefore, you consider that of the parent only, which is 240. So 240. So when you sum it up, you have 10,400 plus 5,760 plus 240, and that will give us 16,400. The next thing that we follow is the non-controlling interest. Non-controlling interest, working 7. Non-controlling interest. Non-controlling interest. You have NCI on acquisition. NCI on acquisition of Megat, and then we also have Mingat. The percentage attributable to NCI on acquisition of Megat is 20%, and that of Mingat is 30%. NCI at acquisition multiplied by the net assets net assets on acquisition of megat and megat. So net assets on acquisition of megat is 8,000. 20% of 8,000, and that will give us 1,600. On acquisition of Mingat, the net assets is 3,520. 30% of that, 3,520, and that gives us 1,056. Then we now have NCI, share of adjusted post acquisition retained earnings of Megat and that of Mingat. So which is 20% and 30%. We got 280 here, and this one we got 460 from the summary of our net assets. 280, 20% of 280, that gives us 56. And 30% of 460, and we got 138. 138. So you sum it up. You add it up, plus 56 plus 1,056 plus 1,600. The value of non-controlling interest is 2,850. Non-controlling interest is 2,850. Then you include it under the equity section of the statement of financial position. Non-controlling interest, that is working 7, which is 2,850. So when you add the 2,850 to 16,400, and the total will be 19,250. That is the total equity. Total equity. We have total equity, and that is 19,250. Then the next thing should be non-current liabilities. Non-current liabilities. Non-current liabilities. Then you move to the liability section of the statement of financial position. There we have long-term loans. Long-term loans. We have 2,400 for Megat, 300 for Megat, and 100 for Mingat. So when you sum it up, you have 2,400 plus 300 plus 100. 2,400 plus 300 plus 100. Then that will give us 24 plus 3. That will be 27 plus 100. That will be 2,800. Then we also have deferred tax. Deferred tax. Deferred tax. We have 500 plus 180 plus 60. 500 plus 180 plus 60. You sum it up. 500 plus 180 plus 60. That will give us 740. When you add the 740 to 2,800, then you have 3,540. 3,540. That will be the total of non-current liabilities. Total non-current current liabilities. That is 3,540. Then you also have current liabilities. Current liabilities, you have trade payables. Trade payables 2,300, 600 and 1,200. Trade payables, that will be 2,300 plus 600 plus 1,200. 2,300 plus 600 plus 1,200. Then you have 4,100. Then we also have current tax payables. Current tax payables. Current tax payables. We have 1,200, 160 and 480. 1,200 plus 160 plus 480. 1,200 plus 160 plus 480. The current tax payable totaled 1,840. Then we have the fair value of contingent consideration. Contingent consideration from the note 2 of the question, and we have 120. When you sum up this, 4,100 plus 1,840 plus 120, that will be totaled 6,060. That is the total of current liabilities. Then you now add the equity, the non-current liabilities and the current liabilities. So to get the total equity and liabilities. Total equity and liabilities. The non-current liability, the current liability is 6,060 plus the non-current liability total 3,540 plus 3,540 plus equity 19,250 plus 19,250. Then the total equity and liability will be 28,850. That is the total equity and liabilities. The total equity and liability must agree with the total assets. It must agree with the total assets. Please subscribe to the channel and be expecting more from me from time to time.